Good morning, everyone. This is JJ Richa with Abysmal Ventures, and I have today with me Joe Gatto. Joe is the managing director of SeedFolio. SeedFolio is a new VC seed VC fund here in the Southland. So we're going to open it up and ask Joe to introduce himself. But before we do that, I'm going just to tell you a little bit of what we're doing and why we do these broadcasts. So what we do, this first of all is going to be about an hour of discussion. It's again really easy fireside chat with Joe, and then we'll open it up for you to ask questions. So if you have questions, don't hesitate. Just get them started as soon as you want. Also, what we want to do is we want to make sure we answer all the questions, but depending on the time we have, if you have additional questions, we're happy to answer them. You can always send them to pvinfo@abysmalventures.com, and I'll be able to forward them to Joe as well. So the purpose of this live stream is really to help startups and entrepreneurs understand the ecosystem, understand what it takes to really navigate the community, how to build a business, how to grow that business, how to raise capital if that's your objective also, and potentially how to exit from that business. So just a little bit about Abysmal Ventures. We are a venture studio where we help startups with their startup needs, from how to build a business, how to invest. We also invest resources as well. So we help you build a business. We help you also potentially some technology on the software side. When we also facilitate funding, we also invest in the companies as well. We open doors to make sure that you succeed. We are going back to building a fund. Hopefully, COVID kind of affected everybody, and so we base our, we are a value-based hybrid cash and equity model, and we engage on a month-to-month basis, no long-term commitments, and we are a true partner to our portfolio companies. If you have not subscribed to our YouTube channel, please do that now. Also, please follow us on the social media so you're always informed of upcoming events. I think that's it. So, Joe, thank you very much for being here today. First is tell us a little bit about yourself so the audience kind of knows you a little bit more.
Sure. Hey, JJ, thanks for inviting me, and thanks for all you do in the ecosystem. It's great how you at Pismo advise early companies and help them raise capital and getting them to the point where they are investable. It makes my job easier. So thanks for that. And for entrepreneurs who don't know it, the venture plan competition that Pismo runs is fantastic, and the educational tracks along with that are like getting an MBA in entrepreneurship. So check those out if you haven't participated. So thanks to you, JJ, and thanks for having me on. Sure. So a little bit about my background is I was founder and CEO of a company myself, so in the entrepreneurial seat not too long ago, and built a company. It was over 10 years, grew it to over 100 employees as CEO and sole founder, raised venture capital, first angels and venture capital, built it up, 32 million ARR, sold it off to a big company, had a nice exit, and that was that. And so after that, I had a little money in the pocket, a little money in the bank, and started investing ad hoc in companies, early stage companies, while looking for my next big thing. And had a few mistakes and and had one really big home run, and some others that are shaping up really nicely. And I said, this is just really interesting. And so I love it. It's a different way to participate in the entrepreneurship ecosystem. And so starting 2017, though, I really ratcheted up to full time and literally 50 hours a week. It's the 50-hour-a-week job with no salary, and doing a member of Tech Coast Angels, Stanford Angels, other angel groups, and started writing detailed memos that got a little bit of a following, and people liked the way I analyzed deals. And I decided to step up. And so so all told, I've made over 40 investments into early stage companies, mostly at the seed stage. And so I decided to step it up to the next level and raise outside funds. All those investments have been with my own checkbook. And so, so we launched SeedFolio, a large portfolio of seed stage investments. We started the concept last year and just went live recently in March. We've made our first 2 investments and looking forward to making lots more and get into the kind of things we're looking for later, if that's interesting.
All right. Thank you, Joe, very much. 32 million ARR, sold it for 100 million. Absolutely amazing. So it's just so people understand, is that multiples of EBITDA when you did it, or is it multiples of revenue?
But probably more of a multiple of revenue. It was a low revenue multiple, about a 3x, so about 3x on 3,300.
Okay. All right. Very good. We already have questions already coming in. So anybody wants to pose questions, please do so. So let's start with the audience question. This is from Zach. And Zach says, what do you consider early stage companies?
Sure. So the spectrum of early stage is from pre-seed, seed, Series A. As I was talking with JJ earlier, what we call seed used to be the level of Series A, right? So the way I think of it, there's no one definition that everyone agrees on, but the way I think of it is pre-seed is the idea, and there's a lot of work left to prove it. With seed, there's evidence that things are working. For me, if it's a software, if it's or any kind of product, at least an MVP is made and it's at least saleable to at least early adopters, so that I can get on the phone and talk with them about what they like, how is this compared to competition, and that really helps cut through a lot of speculation. Another way to describe, and Series A, typically these days, if it's software, Series A is looking for, okay, you've got 1.5 million of ARR and you're growing at 300% a year. That's pretty much down the strike zone of Series A. So we like to think of it at what we, kind of the Goldilocks, not too early, not too late, where we're maybe 200K of ARR, or maybe 0 ARR, but a lot of good traction with clients. In the clinical side or in the medical side, of course, it's not, ARR is not the story. It has to really do with the level of scientific evidence. How close are you to clinic? So I like to, invest where preferably they've already had the IND meeting with the FDA, so they know what's left on their checklist to get to start clinical trials.
All right. Well, thank you. That really explains it a little bit better, at least on the non-clinical, because there is really quite a bit of confusion on what seed and pre-seed and Series A is, or maybe now we have pluses next to them as well. So how about tell us a little bit about SeedFolio itself and maybe your investment strategy in SeedFolio?
Sure. Let's see. So, well, we've done a lot of analysis into venture funds and early stage venture funds, and really it comes down to needing to invest in home runs. Really, these outliers with 20x to 100x return. So the problem is they're pretty rare. They only happen 2%, 4% of deals. And so in order to get into those, you really need a large portfolio. None of us have a crystal ball. We can, think we can increase the odds compared to baseline statistics out there, but we're not going to turn out around, and half of our deals aren't going to be home runs. So when you're dealing with the kind of events that happen with a 2% to 5% likelihood, you need 40, 50 bets we believe you need 40, 50 bets to have a large enough chance of 1 or 2 of those in your portfolio, because that's going to drive returns to our LPs. So those are often, those big home runs are often risky at the early days. And so we're building a large portfolio where each deal has large potential upside. What that looks like in terms of sectors, they're large potential impact with a high return on investment for us. So we're looking at, in the medical field, therapies, things that treat diseases, diagnostics, things that figure out what diseases you have, devices, digital health. We'll also invest outside of medical in select areas with impact, whether it's sustainability or whatnot. We're typically not going to invest in consumer. There can be great companies there. It's just not our space. Retail, fashion, esports, gaming, that's not our stuff. because it's a large portfolio and a modest size fund, our check size is typically about 200K, and yeah, and we'll lead deals. Happy to lead deals if necessary. We do that very efficiently with standard Series C documents, and yeah, that's a little bit about the fund.
Okay. Strategy-wise, I guess maybe you could expand on that a little bit uh, on what do you look for in a company in order to invest in them?
Sure. So ultimately, ultimately, we have a very quantitative evaluation approach. So we are looking. I did my master's at Stanford in a program called Decision and Risk Analysis, and applied that to the corporate world, pharmaceutical companies, oil and gas companies, where you're really trying to quantify big bet, risky decisions over long terms. And so it's actually a lot like venture investing. So we brought that toolkit to us with us when we started SeedFolio. And so what we're looking for is a large risk-adjusted return. And so and what that means is there's four big drivers. First off, what's the valuation? What's the post-money valuation of this deal? What's the future dilution? How much cash is it going to get over the finish line? What's the exit if it's going to be successful, if it is a success, and what's the probability of success? So those are the four key drivers. And so, for example, you see founders come to you and say, oh, well, we're looking to give a 10x return to our investors. Well, yeah, that's if everything goes right, right? You know the statistics from TCA, JJ, where 70% of seed stage companies fail to return investors' money. So 70% of them don't work out according to plan. And so if we are realistic about if this one looks much better than average and it's got a 40% chance of success, well, 40% chance at a 10x is only a 4x on an expected value basis. So I'd rather see the 20x if everything works out with a 50-50, right? And so that would be a 10x. So an example would be invested in a device company last year to treat atrial fibrillation. If it works out, it's a massive market. We've got a good early valuation. It'll be a 44x if things work out. And there's only a 1 in 4 chance to succeed, but that's an 11x, right? 1 in 4 times 44x, 11x. And so that's the kind of high risk, high return profile that we're looking for. Now, to get the numbers, there's a lot of things that you've got to look at. You've got to look at the quality of the team. What's the chance they're going to execute, right? What's the market size? What's the probability that it's going to get to a big exit, et cetera?
Very interesting. You touched on something that's, I think, really, really important, and that is why do angels, investors, VCs in general go for the really big numbers? It's because of what you just explained, because the risk is really high, and depending on the likelihood of succeeding. And that's why I get a lot of these questions, Joe, all the time. Why you're looking for the 20x? Why you're looking for the 30x? It's because what you just explained, the likelihood of failure is very, very high. So, okay, what kind of companies are you looking for? I know you talked about medical. The other day when you and I talked, you talked about that. But only are you doing just medtech or or bio, or are you also looking at maybe software software as service and other types of product companies, I should say?
Yeah. So sure, I'd say we probably end up doing about 75% will be in life sciences, and it mirrors what my so when I invested as an individual, right, without the fund. If you look at my website, you'll see those portfolio companies listed as Fund 1. And now with SeedFolio, with external investment, I'm calling that Fund 2. Well, it's not really a big difference in strategy. It's just bigger check size now that I've got external money. And so we're looking for, it'll probably be about 2/3 to 3/4 health, longevity broadly. So again, therapies, diagnostics, medical devices, as well as digital health, anything making the health outcomes better, faster, cheaper for patients and improving the quality of lives. It's a great thing to feel good about, and it's very lucrative because people pay a lot to extend their lives. Outside of the medical, what's the other 25%? That's everything I'd like to think of as having an impact that I feel good about. So On the other side, it could be sustainability. I'm looking at some really interesting software as a service for facilitating solar with multifamily, pure software. A lot of clean energy investments are how they're trying to sell a big piece of capex, which can be a high friction sale. This is a high ROI to the customer, pure software. So I love software. It's hard to not like the margins of software, but it's going to be but it won't be software for ad tech or martech or there's areas that get us excited and areas we don't. And so generally, if there's an impact, we get excited, and that excitement, that passion about that area, whether it's a passion for learning about this dimension of curing cancer, with passion about this aspect of clean energy, is important. Because if we're not excited about it, we can't do that 40, 80-hour deep dive to really get into the nitty-gritty to get comfortable with the investment. And so hopefully that gives a little bit of a sense of what we're looking for. Impact broadly, mostly life sciences, and then select others. It could be sustainability, it could be efficiency, it could be IoT. But yeah, love software in that other bucket.
All right. Well, thank you. Just to remind everyone, the floor is open for your questions, so please don't hesitate to post your questions in the chat, in your YouTube chat. So I know you kind of touched on the check size. Maybe you could talk a little bit more. Maybe is it a range, or is it what makes you have maybe a bigger check size? And maybe the other question is, do you reserve some for follow-on?
Yeah, good question. For now, the check size is pretty close to fixed at 200K. If the fund expands and gets larger and we get more LP commitments in, that could go up to maybe 300K. But we're pretty much talking in that range. If I had such a crystal ball to know that I should make a bigger bet on this one or a smaller bet on this one, then then I could just pick the one that was going to be the winner, or the two that are going to be the winners. So I don't have that crystal ball. So spreading it out among those who get over the high bar of the 10x return, as I mentioned. You had a second part of the question that I lost. Sorry.
Yeah. Do you reserve some money for a follow-on?
Right. And so relatively small, yes, but relatively small. So there are some early stage investors where they make a small investment and then they wait till it gets to the Series A and they pile on. So they actually deploy only about 20% with new companies and 80% into follow-ons. And we're flipped around. We do our work up front. We get conviction. We talk to customers. We get into the science, as the case may be, and we go all in. We put our mostly our one bet on the table. We do reserve 20% for follow-ons, and there's just sometimes where things go wrong and you're going to get totally crammed down if you don't participate, if you don't pay to play. Right. We're not going to always do that, but sometimes it's the right thing to do. And so it's nice to have a reserve for that. And there's sometimes where there is a later round, and for one reason or another, I will do the 10x analysis again, and sometimes the risk has been reduced quite a bit, and yet the valuation hasn't increased as much. So we will participate in select follow-ons as well.
Okay. Just to make sure the audience understands, what is a cram down?
So many different flavors, and happily I haven't, out of 40, I haven't had to experience too many of those. They don't feel good when they do. And there's been some I've walked away. Let me explain first. So a cram down is where you might have invested, let's just say, $10 million valuation, and the company raises $1 million. Well, they get to the end of the $1 million and they're running out of money, and they had bad news. The product got delayed, and some investor comes along and says, well, we'll help you from going out of business, but we'll come in at a $1 million valuation. So essentially, everyone who thought that they had X% of the company now has 1/10 of what they thought they'd have. So the new money, the new venture capitals comes in and gets a lot of the company for a relatively low price, and that desperate CEO ends up taking that. And often in those, that's what the idea of a cram down is, where there's a lot of dilution due to the new money. And then sometimes there's a pay to play provision where the new investor will put in some of the money and open that same onerous deal up to other investors. And so sometimes it's the right thing to do. And we try to get in when we have leverage. So negotiate so it's balanced. You want to keep the entrepreneurs incented as well.
All right. There's a question from Dave. I don't know what ESG is. Maybe you do, but otherwise, Dave, explain it to us. ESG has been a rising topic in the investment industry with a greater importance on environmental social impact. Do you think that VC firms will place more importance on this?
Yeah, I don't use that label for ESG for environmental sustainability and guidance. And if you put yourself under that umbrella and you hold yourself out, and the VCs with a mandate with that, then they'll do a colonoscopy to look at your procedures. And I think with ESG, different than just impact, that you have to attest that each of your CEOs are going to file, certain criteria. So that's personally, that's not interesting. I don't use ESG in marketing. When I say impact, I usually say a little I impact. And so as far as predicting whether it's going to be more popular, I don't have much opinion on that.
All right. So we got Dan with a question. Dan says, can you comment on investing in software versus hardware startups, and also hardware that requires software embedded systems?
Well, let's see. Most hardware requires some kind of software. So, so obviously, look, no rocket science here. Software is great because of the gross margins, right? You code once and you sell many times. So the gross margins are fantastic compared to actually manufacturing a physical good. The other thing good about software is it's a recurring model. Usually, most of the time these days, right? SaaS, software as a service, where you're paying monthly or paying yearly on a contract basis, and that recurring revenue is quite nice. Even Microsoft with Office, right? Outlook and Excel and Word has gone to the Office 365 because getting the turning the crank of the recurring revenue is a great revenue model, and people will pay as long as they need to use this software. Hardware can be great. When we do hardware, I tend to favor hardware-enabled software as a service. So sometimes IoT companies, hardware is a key component of it, where they're doing some special IoT. But the idea is that then through data transmission to the cloud and monitoring analytics, they've got the customer on the hook for the monthly fees. So really, it's hardware, software that can be. And on the flip side, some softwares are really hard to sell. So, broadly, software is very attractive, high margins, easier sale, but it depends on the price point, right? So it's not just software or hardware. And hardware can be very attractive if there's a recurring component to it. So it's not black or white, but generally, software is very attractive.
Yep. All right. We have Sayed. He's saying, what are some of the companies that you've invested recently, and why have you invested in them?
Sure. For a longer list, I've got, I think, all 40 of them at SeedFolio.vc and under the portfolio page, and you click, and I don't just list the name of the company. I try to, in my own words, give one sentence summary of what the impact is, right? Like curing this kind of cancer, for example. But so specifically, let's see, SeedFolio went live. So yeah, I talk a lot about one of my last angel investments was a device to kind of treat atrial fibrillation, a major heart problem affecting 33 million people around the world. But then once SeedFolio launched, our first investment there was a really clever device that addresses prostate cancer, both the diagnosis and the treatment of prostate cancer. So real briefly, if you have prostate cancer, or if you're suspected of prostate cancer because you have a high PSA test, and 1 million men per year in the US alone go in for a biopsy. When they do a biopsy, since they can't see the tumor, they poke you randomly 12 times. And out of each of those pokes, they take out about an inch-long, millimeter-wide sliver of your prostate. Not a very fun procedure from what I'm told. What these, and then they close it up, they send it off to the lab, and they see what it comes back. The problem is if they say, well, one of those core samples was positive, they don't really know how big the tumor was around it. So what these guys are doing is in real time, they've got an optical spectroscopy tip on a normal biopsy probe or otherwise normal biopsy probe where they can poke it in, and along the way, millimeter by millimeter, they can see if the tissue is cancerous or benign. And if it is cancerous they remove the sample, and then they can take additional samples in the neighborhood, so then they can build a 3D map to see how big it is. And if it's not cancerous, if it's benign when they poke it in, you get a green light, then they don't even have to remove that sample from you to reduce complications. So really excited about that on the diagnosis. And then on the treatment side, same idea, that same tip, but without the biopsy needle, now just a straight probe. When you go in to do the treatment, if you take enough samples around it, you build this 3D map at the time of the treatment, and then you can go in and do a focal ablation, whether it's freezing or heating therapy. But today we can't do focal ablation because we don't know well enough. Tumors don't show up on an MRI. Blood vessels do, but not the tumor itself. So we can't see today where the tumor is. And by being able to see the tumor like this, being able to map it in 3D opens up both diagnostic and therapeutic opportunities. So that's one. Yeah, I spent a long time on that one, right? And we're deep into looking at one. I've written my 12 or 14-page deal memo on it. It's not a done deal yet, so it's a little early to talk about it, but to give you a flavor, it's a really novel immuno-oncology approach. If it works, it can treat all sorts of solid cancers. So really excited about it. Big risk of not working, but really big return if it does. So maybe that gives a flavor.
That definitely gives a flavor, and it's definitely big, and also it's aggressive, trying to really do things that never been done before. And I guess that's part of your criteria. All right, we have Ashkan asking, what are some of the red flags that prevent you from investing in companies that people often miss?
Let's see, red flags that people often miss. Well, so I have to, people often miss. So I think, I'll try to take that in two parts. The thing that people often, so maybe lots of VCs don't, but sometimes angel investors miss the upside. They like to get such a high probability of success that they will accept the 2 or 3x outcome if it does work out. And the math doesn't work out, right? Because you're going to miss more than 2 out of 3. So if the winners are only giving you 3x, you're just not going to make money. So that's specific, I think, critique of some angel investors and investor groups that I've seen. And then so as far as red flags, I can't say that it's what other people would miss. Again, so because I don't have that side-by-side comparison, but red flags would be dishonesty. For me, a red flag is just a lack of being able to be super articulate about the domain and really dive in and slice it up and make distinctions. It's not just, oh, we're treating cancer market. Get really, really fine-grained into what you're talking about. So I wouldn't call it a red flag, but the green flag, one of the green flags needed is serious competence in the domain.
All right. No, I agree. And again, this is part of what we help companies do, is really get that value proposition really fine-tuned so they're able to, translate that to the investors when the investors are doing deep dives. Are you looking, so this is another question from Jorge, are you looking to surf the waves of gaming industry?
Nope.
Okay.
Next.
Maybe why not?
This is not an interest. I tried to cover that before. I don't know if you chimed in late, but we're focusing on health and longevity, and we focus on other impact areas. Maybe you could say gaming has impact for some people. It's just not a passion area for me. It's really hard for me to do the work needed to get comfortable with an investment if it's not a passion area for me. So nothing wrong with it. A lot of people make money on it. That's great, but it's just not for us.
That makes sense. A question from Safe Flight, I guess. What is your typical equity expectations in return for the $200,000?
So a different way to say that is what pre-money or post-money valuation do you invest at?
Right.
And
yeah.
I've invested at 2 million pre-money valuation or post-money valuations where that's 10% of the company, and I've invested at 20 million valuations where that's 1% of the company. So our goal at SeedFolio is to maximize SeedFolio limited partners return. our goal is not to maximize ownership percentage. Our goal is not to maximize number of unicorns. There's a lot of great surrogate proxy metrics out there, like percentage of ownership, but what I really care about is return on investment. And so sometimes you get a high return on investment with a low percentage ownership, and sometimes you get it with a high percentage ownership. So it's not a direct; it's an indirect metric for us, the kind of the percentage of the company. Obviously, the lower the pre-money valuation, the higher ownership, generally speaking, is better. But that's not a hard number.
I guess what you're saying kind of makes a lot of sense. It's really the multiples of return. So if it's $200,000 investment, regardless of how much equity you have in the company, if it returns 10 times, it's still $2 million. Really doesn't matter. So, all right. This is another question. Amit, what type of non-medical companies are you looking to address the new normal and or increased virtual connection?
Let's see. So I looked at one and passed on. So I don't start with here's a thesis, right? So I agree with that thesis. We're in a new normal, right? And early on last year in March, invested in Zoom and love personal account, and are looking at one in the medical, something that's there's a lot of disruption with telehealth, and that's just started, and there's a lot to go there. And it's not just being afraid of seeing people in person. It's just going to the doctors is usually a horrible experience. And so there's a lot of opportunities, not in every dimension, but or in every specialty. There's a lot of opportunities for improving the experience through interaction, whether it's remote or sometimes it's tools by the bedside while you're sitting there waiting 20 minutes, having an intelligent agent take your history instead of having a resident take your history. So there's we like things in that area, but so we've got a few in the medical domain that we're looking at right now. I looked at one recently for virtual presence kind of site walkthroughs that wasn't too crazy about, but it was almost got there. So open to look at things in that space. Like the space, it's clear there's a trend. So it's case by case. We'll take a look at those.
All right. A question from Jorge. It's kind of relevant here. You're looking usually at 10, 20x. So is 3 to 5x in 5 years really under your radar?
Okay. So if you read SeedFolio's manifesto, the fuller story, right, on the 10x is 90% of our investments will be in the 10x, and 10% will be a subset of, instead of the high risk, high return, I call them low risk, low return, or moderate return, fast exit. And try to keep it simple, but because of the dynamics of a venture capital fund where I raise money from investors and I can make new investments within 5 years, and after that I can't make any new investments, I can make follow-on investments. If we get a really fast exit in the first 5 years, then I can redeploy that. And so there's a leveraging effect, and again, with the goal to maximize LP returns. So as part of our manifesto, a small number of the overall fund investments will be in them. But if you say if it's looking like a 5-year return, then I say no. I'm looking at 2-year returns because things take too long. So for me to guarantee that it's in the 5-year window, you've got to be thinking and have a plausible story that's going to be 2 years. So when the 2-year delay hits, it's really happened in 4 years. So yes, that's the asterisk to good question. And in those, if it doesn't meet the 10x, if it meets the 2 to 3 years probable, 4 to 5 years with a slip, then it's got to be a 40 or 50% IRR of our expected multiple invested capital in order to get there. So good question.
Yep. Here's another question. It's from Owen. Owen says, how would you recommend startups to reach out in general? Direct approach such as email register on website, or indirect approach with co-founder participating in various groups, forums, and associations? or because I know Owen, I can help him. So,
If you talk about reaching out to SeedFolio, there's a contact page. We're looking forward to, I've got a plan and a vision, and it's sketched out to have a one-page intake form where you can attach the deck and all that. For now, send contact, I've responded to, I get a dozen inbounds from that per week. I've responded to every single one, whether it's a yes or a no. If it's no, we don't do that, it's not our space, or too early, or whatever the answer is, or yeah, no, that's interesting, send me the deck, I'll take a look. Or if it's scientific, send me a deck and a couple of scientific papers, I'll take a look, and we'll go from there. Again, I'd like to get to that so it's streamlined on the intake. So we have a streamlined intake form, but for now, just use that as a contact, and we respond to that promptly.
Okay, so a question on cybersecurity. Any interest in that?
Generally not. I mean, so do I have an interest in everything at one level, but it's not an area where, when we put out there that we have, this is the kind of fund we're building, it attracts to us a really interesting cadre of LPs, a lot of whom are medical doctors. Now, when something medical comes in, you can very quickly vet it with the relevant, the dermatologist, the oncologist, et cetera. I don't have that much depth in the security space. There are a few TCA members that bounce things off, but it's just also it's an important area, but just doesn't get us as excited. So we don't tend to focus there much.
Right. I mean, it is very big and it's growing like crazy. But again, your fund has to have its own concentration. Okay, so let's bring on another question here. Will SeedFolio be interested in space technology? Space technology technologies have a great impact on technologies on Earth too, such as wireless communication, imaging, and robotics.
As an individual private investor, I've got an investment in Moon Express. It's an interesting area. It borderline fits the thesis of SeedFolio. Absolutely willing to look at anything in the space. It's super. The geek in me is drawn to it and definitely want to look at it. So it's not sweet spot for us, but impact has some wiggle factor in its definition.
So, question on really the multiples, because I think we talked about that a lot during the fireside chat here. When you're looking at the multiples specifically, are you looking basically at comparables and what were their exits and multiples of either EBITDA or maybe multiples of revenue? Is that what you were talking about when you try to decide if this is investable at 10 or 20x potential multiples?
Oh, right. I'm sorry. So thank you. The multiple has two meanings. Sometimes people talk about a multiple of something like sales or EBITDA is kind of the comparable. So, PE of 15 or a 8x sales for SaaS is kind of comparable. That's not what I'm talking about. Those are useful to look at, and when you're, and it's good to know that when you're looking at software, they're more likely to get a higher multiple of sales than a hardware company might get with the same level of sales. But no, that's not what I meant by multiple. By multiple, I meant multiple of we're investing $200,000, and the company, if at the end of the day the company pays us back $2 million, that's a 10x. So we're talking about return on our investment is what we mean by multiple. Now, how do you get to that? Well, I could probably talk about that for an hour, but there's like I said, there's four factors. Well, forget about the probability of success. Let's just say it is a success. Well, how big is this going to get? What's their aspirations? Is this a device company willing to accept a $30 million exit, or are they not willing to settle for anything less than an IPO? Are they, how big is the market? How attractive to potential acquirers is what they're going to do? How much revenue can generate? So, if everything worked well, what would be the value of the enterprise, right? Is this a $1 billion exit? Is this a $200 million exit? And then, well, divided by what? If we've invested at a a $20 million value, post-money valuation, and it's a $200 million exit, that's a 10x. If we invest in a $20 million post-money valuation and it's a $2 billion exit, then that's 100x. So the X that I'm talking about is relative to the current investment. And actually what I just said is wrong, because a $1 billion exit, so let's say a $200 million exit when we've invested 20 million is not necessarily a 10x, because we haven't talked about how much dilution happens along the way.
Exactly.
If they had to raise 30 million on a 30 million pre, yay, big number, we got a 60 million post-money valuation, but that's half the company. So now you invested 20 million, they end up exit at 200 million, that's not a 10x, that becomes a 5x. So again, the calculation relies on value given success of the enterprise value given success, like 200 million in this case, divided by the post-money valuation that you invested at, post-money, not the pre-money, times 1 minus the dilution required between this post and the exit, right? And then that's the multiple invested capital given success. But it might not work. So then we add or multiply by a probability of success. Right? What's the probability it's going to get there? So if it was at 5x, but it's only a 50-50 chance of working, now we're down to a 2.5x. Hopefully that explains. I don't realize it's a little dense, especially without our decision trees, but hopefully that helps.
Right. With the decision trees, dilutions, too many things that go along the way. Any potential interest in payer-provider, a prior authorization software space? That's, I guess, healthcare related here.
Sure. Love things that healthcare expense as a function of GDP is astronomical and growing at a better rate. So on the one hand, a lot of our investments are profiting from the deep pockets of healthcare. On the other hand, love to try to work to change the system to make it more affordable and accessible to all. So, absolutely is the short answer, and then the details become deal specific.
All right. This is an interesting question. Are you open to invest, i.e. 50% mezzanine debt and 50% equity, asking for mezzanine a lesser return that permits a higher return for the equity in line with your standard expected return?
I don't know. I'd have to look at the term. I do convertible debt all the time.
This is mezzanine. It's different.
Yeah. So I'm not an expert in mezzanine debt. Haven't done a lot there. So I'd have to get into the term sheet and see the details. Sorry. If you have a particular deal offline, feel free to send it to me, and I'm happy to look at it quickly.
Yeah. Do you have a good reference for that calculation? I guess the previous one related to the 10 times.
So if you go to our website, seedfolio.vc, in there's a tab called Process, and it lays out our process from screening, analyze, evaluation. One's called Quantify. If you would just jump to that Quantify, it's kind of like a blog post, but it's in order, so it's also like a web page. So I go to the Process tab and then look at the Quantify, and I give a whole story about how I calculate an expected multiple invested capital.
All right, Joe, how many companies do you look at, do you think, on a monthly basis?
Lots. Probably between 20 on a slow month and 50 plus on a intense month.
Yep.
Lots of pitch fests. Sometimes in January, go to JP Morgan or Biotech Showcase, BioInvestor Forum. So beginning of the year and October tend to be super busy with pitch fests, and then things slow down a little bit in the summer and a little bit with the holidays. So probably 20 to 50.
Yep, that's probably about what we see. How many of the 20 to 50 a month or total a year, out of the ones you see, how many do you think you make investment in?
Sure. So we're, as I mentioned before, our manifesto, which is a little bit different, is it's a large portfolio. It's not spray and pray. We do detailed work on our investments, but it's going to be about 50 investments. So if we say it's 48, so that if we say it's 48 over roughly 4 years, it's about 1 a month or about 12 a year.
Yep. Okay, that makes sense. That's similar. I have a question. It is kind of similar to the question that was asked before. What are the pet peeves or turnoffs? Well, maybe about decks that you review, I guess, or you receive. What like kind of like, oh my God, another one of those?
Yeah, they're pet peeve. Yeah, I got one pet peeve is it's pet peeve is much annoyance. It's more of an eye roll than anything else. But it's top down TAM analysis, right? Well, according to Markets and Markets or Forrester Research, this is a $27 billion industry. That's just there's so many layers of problems. If that's the best that you can do as an entrepreneur, it says you were lazy and all you did was a quick internet search. It means you don't actually understand what went behind that, because those are usually paywalled research documents that cost $20,000. It means you haven't probably talked to enough customers to have granular level of detail. So I like to see bottoms up TAM, because it's not just the numbers, it's the thought that goes behind it of realizing that, okay, well, within this market, really there's only a subset that's relevant. It's not just the SAMs, just lowering it down with arbitrary percentages. It's really, we know. So for Starmine, for our company, we could talk about the 10,000 portfolio managers out there. Well, but we had a very quantitative product. So we're really only targeting the really quant-focused subset of that universe. So we're down to maybe 2,000 out of the 10,000 portfolio managers. And if you don't understand the differences between those portfolio managers, how they think and act differently and how they use data differently, the size of their portfolios, their velocity, their turnover, if you don't understand those, you won't be able to sell to them. So when if people have a good customer information, they can fine tune and really slice and dice their market. And and when you see something top down like this, Forrester says this market is, and it's a $100 billion market. Cancer is a $100 billion market. If we only had 1% of that, that would be $1 billion. Well, it's just not interesting.
It annoys me as well, and like if somebody's selling something to hotels, they'll talk about the travel industry. It's like, it's not travel, it's just hotels, and what type of hotels, and are you talking about the small one, or are you talking about the franchise and the Marriotts and the big ones? So yeah, you're right. It's by itself, on its own, it just tells you that someone hasn't really studied it well enough to say that's my real target. So, and the other thing that kind of annoys me too, Joe, is that they try to make it much bigger than it is, and it doesn't have to be. So, really, all right. So we have some more questions here from this is from Sayed. How early stage companies do you normally invest in? Do you look for animal data as POC for early stage companies?
If ultimately we're trying to treat things in humans, and animals are easy, cheap proxies, but the quality of the model varies, right? So sometimes mice are good models of how things work in humans, and sometimes they're not. Sometimes you need to go to primates, et cetera. So it's early stage. They may not have 20 million in the bank account to do all the best standard. But so what we're looking for is generally not just one. Usually it's multiple animal studies, and it's with impressive results and a clear understanding of mechanism of action. It's not like, oh, we gave this compound to the mouse and they got better. We don't know why, right? If you can't tease apart the mechanism of action, then it's just a little bit of, it's a lot harder of a leap of faith to buy, because if you don't understand the mechanism of action, then you can't compare the suitability of that mouse model to the human model, for example. So generally animals, again, as I mentioned before, preferably they've got preferably they've already got the IND approved and they just need money to get started and invest in those, or they had their pre-IND meeting with the FDA and they're halfway through the models, and there's got good signs already on safety and efficacy and tox that you can kind of connect the dots and make an educated, risk-based assessment.
All right, another question from Michael. How did you get the flywheel of deal flow coming to look at?
Good question. So let's see. So when I started back in 2017, TCA was a starting point, and I branched out into Tech Coast Angels, and now I'm either directly or indirectly associated with multiple angel groups. But as I was raising SeedFolio, while I probably have had more conversations and met more people in the last 9 months than I did in the prior 20 years. And there's really a lot of Zoom calls and phone calls to meet people. And kudos to my venture associate, Brandon Bremer. I'm a bit on the introverted side. He's on the extroverted side. Excited about what we're doing. And, he'd set up tons of meetings with anyone from people who could be potential LPs to potential deal sources. Lawyers around town are great. Intellectual property lawyers and corporate lawyers, they end up seeing companies early. Oops, maybe I gave away a secret there. But these are folks that are, in the deal flow. And so, reach out, make connections. And so it's been a lot of work.
All right. How do you move from a bad investment decision?
As quickly as possible.
Yeah.
So presumably from a bad,
right.
I distinguish decision and outcome, right? So I'm going to make decisions, and they could be a good decision and have a bad outcome, right? And so a lot of people don't make that distinction. And all I can do is all I can do. If it was a bad decision if I didn't take into account what I could have taken account at the time of the decision. It was a bad outcome if it didn't make money, right? And sometimes there's bad outcomes because of completely unforeseeable, and I don't beat myself up about it. That's just part of the game. Again, 70% at TCA, 70% fail to return investor capital. Now, when an investment decision, when an outcome goes bad, I always ask myself, what can I learn from it? And by the way, an investment decision can be saying no to a company that turned out well. So to the extent possible, I have my shadow portfolio, so that anytime I see in the business journal, here's a company that did well, did I know about it? And if I didn't know about it because they were raising before I really got active, no big deal. But if I knew about it but I passed, I want to read my notes and say, where did I go wrong? Right? I saw this SaaS company, and people were investing in and hot and heavy about it, but I got in. I thought I was doing great due diligence, and I found that they plateaued for 3 months in a row, and so I passed on it. And then, well, that was a hiccup, and they ended up going up. So I've learned a lesson there to understand why that hiccup, and sometimes there's good stories behind that hiccup. That's on the one type of decision where bad outcome because I didn't invest. On the other side, there's like, well, I want to know what signs were there that I could have seen that I didn't, and I will go back and change my process. I will go back and add that question to my questionnaire list or whatever it is. So always learning. Not all outcomes meant there was a bad decision. Sometimes there was, and from those I want to learn from them.
All right. Question from Sandy. Do you recommend a very targeted market strategy for a knowledge-based platform or a general market approach?
You should probably take that one. You're the incubator, JJ. What do you recommend?
I know Sandy very well. So it's his question is very specific. He's trying to build a knowledge-based platform for different industries so that people can get information about what they're looking for, or they find information about what they're looking for.
Okay.
And that's, go ahead.
And do they have sales currently? Just real briefly.
No sales. Okay. Still in the very early stages.
Yeah. So without knowing anything more, and it may be completely off base here because I don't know Sandy or his company, but when I see knowledge base and market, so sometimes there's technology in search of a problem, or technology that resonates better with some potential customers and others. And so people talk about value proposition. The product is what you can propose, but the value is what customer sees. So I would ask, if you say a general market approach, well, a general market means multiple verticals. So how many verticals have you talked to where you've talked to a dozen people in the vertical? Say, here's what I'm offering or going to be, I don't know what the stage of development is. Here's what I have or what I soon will have. Will you buy it at X price? Would you buy it at any price? Would you use it if it was free? And so if you don't know where to start, you probably have some intuition about the top 3 or 4 areas, and do a deep dive with potential customers in those areas, less salesy and more needs assessment, and throw spaghetti at the wall that way and see what sticks. Preferably you do that actually before you build a product, right? You read something like the lean startup, right, where you get the customer feedback before you spend a lot of resources on developing a product. So again, talking out of turn because I don't know Sandy's product there, but that's
I agree. A couple of questions here before we're coming to a close. So, do you have interest in nutraceutical market?
Probably not. Generally, I'm looking for a claim, and if it's going to be a real claim, then there's going to be an FDA approval process to it. So, if there's an FDA approval process where some efficacy can be demonstrated, then yes. But other than that, probably not.
So, question from Christian: how to reach you? You can go to the website, as he said, Christian, and you can reach him there. You can always reach out to me, and I'll make an introduction. Last question, really, before we end. I think it's important for the audience to hear your answer on this. Have you, or you do have a very quantitative approach to evaluating the deals. Can you kind of tell us a little bit more about that approach?
Let's see. So, as I mentioned, I can point you to the website. I can reiterate that I'm looking at the exit given success, and the exit can be a function of market size, market share, stage that you're going to sell this. You're going to sell it after a 20-person proof of concept, first in human, or are you going to take it all the way to the sales? So I'm looking for how big will it be if it is successful? What's the dilution needed to get from here to there? What's the post-money valuation of the deal that we either is on the table or that we negotiate? And what's the probability of success? And probability of success could be multi-branch tree. It could be some probability of a big outcome, middle outcome, small outcome, and 60% chance of total failure. So those are the 4 dimensions: probability of success, exit given success, dilution, and current post-money valuation. And again, for more about that, where I lay out the story with a decision tree where it's easier to follow, I give a fictional example, but it's very realistic. At a website under the process tab, SeedFolio.vc, under the process tab, and you can read all the process, but if you want to jump to the quantification, one of the sub pages there is called Quantify, and it's about a 2-page long article where I lay out that approach in detail.
All right. Well, thank you very much. So I'm going to ask you to, I'm going to do a little bit of a closing. I'll come back to you. Maybe you can think of maybe one recommendation that you would recommend to entrepreneurs when raising capital. What would that be? So I'll be right back. Just wanted to thank everyone for being here today. As usual, great discussion. And Joe has been awesome. I wanted to make sure that you guys subscribe to our YouTube channel and our social media so you can stay in touch with all the new things that we bring to you. This YouTube and this broadcast, I should say, will be it's recorded and it will be available by tomorrow morning on YouTube, and you could revisit, or you can pass to others to look at. Again, any questions you may have, you can send them to me, and I can pass them on to Joe, or you can just go directly to SeedFolio.vc and contact Joe directly. Joe, tell us what it is, that one recommendation.
that's tough on the fundraising because it really depends on where companies are. On the but at the stage that you're fundraising, you're often trying to establish product market fit. And I'd say even before, maybe meta advice is even before fundraising, if it's a product, right? If we're not talking about a cure to cancer, right? With cures to cancer, right? If you cure prostate cancer, we're pretty clear on the market size is enormous, right? But for your software, your IoT, your other analytic, really get to know the customers and why they would buy and why they would not buy. How big is their pain problem, and what would they pay, and why? What problems that solves? So really understand and be able to slice up your market into those who care and those who don't care. And if you do that in advance, sometimes you might avoid spending investment capital on in a direction that wasn't going to be fruitful. It's just amazing how you can vet that out talking to customers. And a lot of founders are technologists, and they've worked and developed the technology, and then they think about, okay, what market should I go after the fact? So I just say maybe think about flipping it a little bit, and a great resource on that is the book Lean Startup.
All right. Thank you very much, Joe, for being here today. This was a great discussion. I really appreciate your time.
Thanks, JJ. Good to be here.
All right. Thanks for everyone. We will see you on the next broadcast and hopefully in the next couple of weeks. Talk to you soon. Thanks, Joe, again. Have a great day. Bye-bye.